Yeah, hi there, it's Victor here. Hello. Welcome, ladies and gentlemen, boys and girls. Welcome to another session of how to grow your wealth. Today we'll be talking about mutual funds investment. So all three different levels. So entry level, intermediate level, and advanced level in mutual funds investing. But to fully understand the concept, I'm just going to break it down into some subsections to make it, flow and consistent. So the section will be what are mutual funds, how you can select mutual funds prospectus. I think that's the best section because that gives you completely what you need to comprehend before getting into mutual funds. And then we'll also do the pros and cons of mutual funds. You see, I create this content, this educational video, just an education tool for people who are getting into investment. Because study shows that if you want to get into any investment venture, you have to make sure you understand all the concepts in that particular investment venture. Getting into an investment venture without fully understanding it, it's like someone trying to cross a highway with fast-moving cars. What will eventually happen is that you might dodge one or two cars, but at the end you will crash. So there's no way you can run through, let's say, a 4-lane or a 5-lane fast-moving cars and you successfully go through that. So that's why I always suggest that due diligence have to be taken. You have to attend seminars, you have to read books. That's why I always recommend some best-selling books when it comes to investment, like The Intelligent Investor by Benjamin Graham, Little Common Sense by Jack John Bogle. We have Rich Dad Poor Dad by Robert Kiyosaki. Tony Robbins, we have Money Master the Game, and finally we also have Snowball by Warren Buffett himself. So that being said, let's get started with mutual funds investing. It's your first time here, welcome. Please subscribe and press the bell button to be notified anytime I upload a new video. So the first section is what are mutual funds? Well, just like I did before when we talked about stock market for beginners, which I'm sure anyone watching this video about mutual fund might have already gone through that. If you haven't, just click on the link at top. It's stock exchange for beginners. So with that, you fully understand how we are moving now from individual stocks to diversified portfolio. And when we talk about diversified portfolio, now comes mutual fund, which is simply a bucket of stocks and bonds, or you can say a pool of fund, which include bonds, stocks, and all the different stuff. So mutual fund is different from individual stock. If you want to buy individual stock, you can just go right away and buy Coca-Cola, or you buy Gatorade or Walmart. But when you go to mutual fund, it's now those individual stocks inside a bucket or inside a pool. So most people would prefer to buy a diversified portfolio, which is like mutual fund, rather than individual stock, because when you diversify, you try to bring down the risk. So again, just to recap, mutual fund is a basket of individual stock, or you can say a pool of individual stock. That is the simplest definition. I don't want to go into the theoretical one, which might get you confused. The simplest way, basket of individual stocks or a pool. So instead of you investing in a single company or a single stock, now you have diversified, which gives you more options. The next section we are going into is how to select mutual fund. It's preferable to go into a financial institution knowing exactly what you want. Because if you know what you want, then you'll be able to pass your message to the financial manager or the portfolio manager, letting them know exactly what you want to invest in. And there are some different ways. There are different ways where you can really look into the mutual fund and know exactly what you are investing in. Just like I mentioned before, if you get into any investment venture without fully comprehending, then eventually you might crash. So very important. there are ways that you can select your mutual fund or know exactly what you are going into. Every financial institution, every bank, on their website, they have a mutual fund screener or a simulator. So you can go in that app, you put in, you choose if it's domestic or international you want to choose, the risk tolerance, you can see the performance history, and you can select and know which fund you want to get into prior to even going to the bank or the financial institution. There are also third-party software, something like Morningstar. Morningstar.com also gives you a way where you can screen, you can know which type of mutual funds you want to get, and once you get that, you can, when you go to the bank, you tell them exactly what you need. So it's advisable to have an idea of what you want before even going to the bank, because if you go to the financial institution without knowing what you want, what will happen is that they will start suggesting to you, like, go with this, go with A, go with B. You have no idea what A and B is. That's why it's very advisable. Try to, go through the screener, know what you want before going in. Okay, so that's it for, sometime when you go in, let's say you go with Manulife, you go to Manulife Financial, you go on their website, it will give you all of the examples. Some of the examples of mutual funds with Manulife is the Manulife Dividend Income Fund, and the symbol is MMF 34629. If you want to go with the Royal Bank of Canada, then when you go to their website, you can screen through. One of their mutual funds is the RBC Global Equity Fund Focus Fund, and the symbol is RBF 1067. Equally, when you go to Toronto Dominion Bank, one of their mutual funds is the TD Strategic Yield Fund, and the symbol is TDB 3044. So those are ways that you can select, have an idea of what you are going into before moving and selecting a particular fund. Okay, we also talked about the next section, which is mutual fund prospectus. As I mentioned earlier, this is the most important section when it comes to mutual fund. Why? The mutual fund prospectus is a formal document that summarizes the details of the fund or the investment venture. It's advisable that investors know exactly what they are buying, and when you look at the prospectus gives you all the detail. So you'll see stuff like the fees and charges, you will see the minimum investment balance or the minimum investment amount if it requires that. You will also see the performance history, which is very important. You want to know how that particular fund is performing for the last 2 years, 3 years, or even 4 years. It also gives you the risk tolerance, how far you can go. And it's mandated, the mutual fund prospectus is mandated by the Security and Exchange Commission that every financial institution provide that to any investor prior to them purchasing or buying the fund. So it's mandatory. I talk to some people, they don't even know the fees that they pay, they don't even know the risk tolerance. So my question was, did you receive the prospectus? And some of them don't even know. They don't even know there is something called a prospectus when it comes to the mutual fund. Very important, try to comprehend the prospectus before getting into any investment venture. 80% of people are under the impression that the financial institution owns the mutual fund. Now, little do they know that mutual fund is pretty much just individual stocks in a basket. So that's one of the things. If you don't go through the prospectus, you don't even know which companies are in that fund. Yes, so advisable, look at the prospectus, very important document, especially when it comes to fees, because we're going to talk about the most important thing when it comes to mutual fund, which are the fees. So the first line of the prospectus is fees and charges. Mutual funds are actively managed by portfolio manager or fund manager. You pay them to manage your money. So they trade in the stock market, they buy and sell, but you pay them. So it's good for people who, they are not too familiar with the stock market, but they just want to get involved, or they want to try to reap a little bit of the venture, they might go with mutual fund, as opposed to people who are experienced who will go with index fund or something more complicated like the exchange traded funds. So when it comes to the fees for mutual fund, the structure is breaking down into 3 fees. There is the management fee, which some people call advisory fee. That's mandatory. You have to pay them to manage your money. There is also a load fee. You know, when you do transactions, when they buy and sell, it's called a load fee. So anytime they purchase or they buy funds, which normally with mutual fund is priced and traded once a day, there is a fee. So when you buy, they call it the front end fees, and then when you sell, it's called the back end fees. So we've already talked about management fee number 1, load fee number 2. The third fee is administrative fees. Administrative fees is for bookkeeping, arrangement of files. You also pay. So you have 3 fees. When you lump all the 3 fees together, it now gives you what technically they call the expense ratio. Some expense ratio might be in percentage or decimal point. You can do the conversion between percentage and decimal point easily. But your takeaway today is that when it comes to mutual fund, 3 fees: management fees, load fees, and the administrative fees. Once they put all that together, that's what gives you the exact fee of what you're paying. So that's about the fees. So now we're going to move over to the pros and the cons when it comes to mutual fund. Very important. Let's start with the pros, some of the advantages. With mutual fund, it is diversified, which means it's not an individual stock, it's a bucket of stocks within the same similar industry. Once you diversify, it gives you less risk. One advantage is that mutual fund has less risk because you diversify. You have different shares and stocks inside, the basket. It's not like individual stock where, let's say you buy Walmart or Pepsi Cola or Target. If something goes back, you might have a bear, it might goes down, the bear market. But with mutual fund, even one of the shares are going down, it will be supplemented. The other shares might go up and try to balance it out. So that's the first advantage. The second advantage is that it's a very easy way of investing, because you don't have to do the management. You just go to your bank, they choose a portfolio for you, you pay your fees, and they manage it for you. So it's easy method of investing. The third one is that it's highly liquid. So you can buy today and sell tomorrow. Very easy. With mutual fund, you can sell it easily. It doesn't have to remain with you like some penny stocks where you buy some stock less than $2-3 and it's difficult for you to sell. So with mutual fund, it's highly liquid. Number 4, it's a wide variety. So there's a lot of them, so you can choose. You can choose if it's domestic, if it's international, if you want more on bonds or stocks based on the 80 to 20% ratio or 20 to 80% depending on your risk tolerance. If you are a young guy, you can go with 80% stock and 20 bonds. If you're an older guy who you don't want to lose money, you're scared of risk, you can go with 20-80. So those are the pros, the advantages when it comes to mutual fund. Now let's go to the cons when it comes to mutual fund. Con number 1 is high fees. Just like we talked, it's expensive. It has a 3 structure breakdown: management fees, load fees, administrative fees. So it's kind of expensive. That's why some people will prefer to be knowledgeable, to try to learn a little bit about stock before getting into index fund or exchange traded fund. The second disadvantage of a mutual fund is that you have no control over your funds or over the management, because there is a portfolio manager who is managing it for you. If he underperforms the market, he still takes his fees. That's why sometimes you might look at the market is stagnant, there's no appreciation, but what happened? You will still see a dip on your mutual fund because some of the fees are taken off even if there is no appreciation. So the second part is that you have no control. The third disadvantage is that mutual fund is priced and traded just once a day. Now what does that mean? Even if the price fluctuates, goes up and down, you only have the tendency to buy and sell just once a day. And once the market closes, you cannot trade anymore. Just like with index fund where you can trade as much as you want, or day trading where you can buy and sell, that's high frequency. With mutual fund, once a day, and that's not a good thing, because if you are in the stock market, anytime you see an appreciation or equity, you want to make money. So once a day is not good. And then the last disadvantage is that some of the mutual fund requires a huge amount of investment to start. So it's not like the other day trading or index fund where you can just start with less than $50. Though some would say you start with a minimum like $3,000 or $4,000 to get into. So those are the disadvantages. So we've talked about the pros and the cons. Have you ever noticed that anytime the balance in your account moves from $3,000, $4,000 to $5,000, you start getting calls from all these financial institutions, and sometimes you are thinking, oh, that's good customer service. But as a matter of fact, what they're trying to do is that if you have money in savings account or the CD or the checking account, they don't make too much money. They want to move you. They're trying to lure you into something like mutual fund where they will have those high taxes, the structure, so they can reap more from you. Because when you go with checking account, saving account, they don't really see much on that. But when you start going on the high fees portfolio, that's when you see more and more coming up. You see, the main objective here is to grow wealth. And Robert Kiyosaki, who I always suggest his book down here, is the writer of the book Rich Dad Poor Dad. He said, and I quote, mutual fund is for laid-back people. Now, what does he mean? It means mutual fund is for L people. And I kind of reckon with him, because who better manage your money than you? What the portfolio managers are doing in the bank, you can easily do that by just reading some books, attending some seminars to put yourself up to the investment level. So he mentioned that it's for laid-back people, but I personally think that mutual fund is a financial trap for the novice to benefit the large institution. Which brings us to the end of this session. If you find this valuable, please subscribe, share, comment down below. I would just like to know what you think about mutual funds. Until then, I'll see you in the next video. Have a nice day. Goodbye. Thanks for watching, and please don't forget to subscribe.